All right, and we're live on Energy Superheroes with Hadi Balasubramanian. He is the managing partner at Eco Advisors, which is a consulting firm. Hadi is also the founder of Eco Investors, which is an investment platform. He has a nonprofit background, moved into finance to have a bigger impact, and he's helped advise on the deployment of more than $4 billion in capital across the sustainability value chain. We're excited to have you, Harry. Thanks for coming on the podcast.
Thanks so much, Peter. Lovely to be here and looking forward to this conversation.
Absolutely. So you're the first that we've had on the podcast that started with a nonprofit background. Could you go into that a little bit? I think that's interesting to the audience.
Sure, yeah. So as you described, I come from a kind of a purist environmental background. I started off as a tropical marine conservationist, living and working in Southeast Asia, the Indian Ocean, Southern Europe, and the Caribbean, primarily at the interface between coastal communities and the resources underwater. So I spent my time living on beaches and scuba diving, but also interacting very closely with those communities that are so closely associated with nature. After initial projects in the tropical marine space, I worked for Conservation International, which is a large environmental nonprofit, one of the largest in the world. And I thought that the way to address sustainability challenges was primarily through philanthropic efforts or voluntary efforts. And CI and the Nature Conservancy and WWF are those organizations that do the biggest and broadest scale work in emerging markets in particular. What I did find, though, is that while there was a tremendous amount of good work happening, support to great organizations, local communities, and indigenous people around the world, there just wasn't enough money. So how do we address the fiscal gap between what's needed to solve these problems and what's available in the philanthropic and public sector budgets?
That makes a lot of sense. So you scuba dive. Do you still scuba dive today, or have you given it up completely?
Well, I do say in my bio somewhere that I traded my scuba suit for a business suit when I go to Wall Street these days, but I still keep my regulator, so I do go scuba diving whenever I can, and we do have a large kind of ocean sustainable investment focus and lens in our work, and in fact we just published and we're releasing periodically through this month and the next couple of months a review of sustainable blue economy financing from the last 20 years that was funded by the Walton Family Foundation. And we try to use that as instigation for more investment into the sustainable blue economy, but also it helps me get back to those coastal communities and underwater and scuba dive whenever I can.
And now, very cool. Yeah, I'm down here in Jupiter, Florida, and we do a good bit of scuba diving here. It's one of the only places, a little plug for our area, where you can dive without a cage with sharks. So super cool, including the bad ones. We've got bull sharks and tiger sharks and all that stuff, but a lot of people don't realize that, sharks are not something to be feared and that they're an amazing part of the ecosystem. So a little bit of a diversion there. We'll definitely get into the finance, but I had to touch on something that I think we both share in common, a love of scuba diving and underwater communities. So very cool. So then tell me how you made the transition into finance, and you started with consulting as Eco Advisors, and now you're moving into building an investment platform. Would love to hear about both your consulting work and your vision for the investment platform.
Absolutely, Peter. So as I said, my thought in the beginning was that philanthropic work was going to drive the changes that we needed for sustainability. And those fundamentally were the solutions for climate change and biodiversity loss that I was most interested in. Now, Conservation International has an interesting background and legacy. Our founder is Peter Seligman, and he was tremendously, well, he still is, he's tremendously passionate, charismatic, and is able to draw a lot of people into the tent for sustainability action. He was also able to build an amazing blue chip corporate board with a lot of senior executives from major companies in the US and around the world. People like Rob Walton and Howard Schultz and Bob Fisher of Gap and Byron Trott, and the list goes on and on and on. What I found, though, is that while we had a focus on business development and engaging the corporate sector and engaging the public sector, we didn't drive as much action and dollars towards sustainability as I thought was possible. So the transition from the nonprofit world to the for-profit consulting world was primarily premised on the notion that we weren't generating enough resources to solve these problems. We know that we need quite a lot of resources on an annual basis to fix issues like climate change and biodiversity loss. And the philanthropic and public sectors just don't provide enough of the capital. So the notion of building eco-advisors in the first instance was really to understand and communicate the benefits of acting with purpose and sustainability for all investment decision makings and operational decision makings. Because fundamentally what we were seeing is that there wasn't enough awareness around the fact that you didn't have to choose between either having a positive impact on the planet or generating profitability and increased revenues, that you could do both at the same time. Now, eco-investors is an evolution of that thesis, which is that, 10 years ago when we founded eco-advisors, there was still a gap in knowledge and understanding how to connect these two things. Now we have a lot of people making commitments to net zero. We have a lot of investors and institutional investors in particular understanding that it's not a trade-off anymore. But the challenge they have today is in allocation and finding products that are credible, that drive sustainability solutions and are consistent with the fiduciary responsibility of investors. So the notion and the reason for building eco-investors capital is really to address that supply gap in investment product. So what we're building right now is a one-stop shop for all of your environmental allocation needs, across from philanthropic to concessionary and commercial investing, but across asset classes as well. And really is trying to sift through two fundamental gaps. One is the supply gap in product, and two is the knowledge gap in understanding how to make investments in this realm, because it's somewhat different from a sourcing, diligence, and oversight perspective than conventional investing.
Oh, very, very good. Let's dive deeper into that. How do you see what do you see the differences with an environmentally conscious or an impact investment compared to a more traditional investment around just what you said, the diligence area and sourcing and the whole process?
Yeah, so it's a great question. There's a lot of subtle differences. I'll talk about a few of the large ones. So I think one of the largest ones is just understanding what the solution set looks like for the problems that we're facing. And conventional investment managers don't quite understand the solution set and the challenges from an environmental perspective to the degree necessary to understand what is actually going to solve those problems. So when we think about challenges like climate change, it's really hard to wrap your hands around and your head around the whole global problem of climate change. But when you downscale it to specific industries and specific sectors, you can see that there's solution pathways that make sense. Now, at the same time, if you don't have a sound understanding of the science behind climate change, certain things that look appealing or attractive because someone else might have brought it up or invested in it, or it's the sexy darling of the venture community today, may not actually materially influence the pathway to a sustainable future. I think that's fundamentally the most important piece that we bring to the table, which is a solid understanding of the environmental problems and challenges, and then what solutions are actually materially going to influence a pathway to productivity. From there, it's sourcing the right deals that fit into the pathways necessary for emission reductions on the climate side and biodiversity preservation and water security on other environmental variables. And then the diligence kind of is different as well. So the deals that we see that are addressing real solutions to the problems in sustainability may require sort of a little bit more oversight on management teams, on processes, on the scaling potential and commercialization potential of the entrepreneurs. And often what we see is that conventional managers view those as risky attributes, and then those deals don't get financed.
Understand. What sort of metrics, hard metrics, are you looking at, or do you think that today maybe those metrics are missing, and is creating new metrics part of your what you guys plan to do, or do you plan to lean on other sort of metrics providers that are out there? We look at one called Sustainalytics that's out there, but there are many others that are trying to bring metrics to the table, but it still seems to be, a bit fuzzy.
There's a fuzziness, Peter, but there's also just a proliferation of types of metrics. And it comes back to this idea of what we mean by sustainability. So the first and most fundamental piece that we need to understand is what exactly are we trying to solve for, and how can we capture information and data that drives us to the solutions that make the most sense. So you're absolutely right that there is a proliferation of metrics. There's a proliferation of data inputs and sources. There's a wide variety of what that data looks like, how clean it is, how useful it is in interpretation and analysis. Our view on this is quite simple. It's that there are a variety of metrics that exist today. The environment is a little bit easier from our perspective than the broader SDG set and social indicators in particular, in that we can find quantitative indicators for most environmental attributes, and we don't have to rely solely on qualitative information, which is very subjective. So if we can tie both quantitative measures and qualitative measures to environmental attributes, we feel that like we have a verifiable, authentic way to look at environmental performance. Now the challenge, and it's a great time for this discussion, because the challenge of what that fundamental set of indicators and metrics looks like is still being debated. And you mentioned a couple of tools that are available today. There are more tools that are coming online, and there's actually bigger efforts through the UN and the SDGs, the Sustainable Development Goals program, a program called the IMP, so the Impact Management Project, which is really trying to look at and consolidate information across all of these metrics providers and standards bodies into a core set that really respond against the 17 SDGs and then the targets under the SDGs under the UN framework. Now, we're not all the way there as a society. There's a lot of work being done in consolidating the right information. There's also some interpretation that's necessary to understand what you're doing with the information. So Sustainalytics is very good to link kind of activities with the Sustainable Development Goals, but it doesn't get you to the point of understanding and managing risks associated with sustainability or opportunities that you could benefit from a sustainability perspective. And it doesn't go further along to the outcomes and kind of results of what sustainability looks like, both from a positive perspective and a negative perspective. Other tools are helping us do that, but we need a clear taxonomy, a clear language set, a clear accounting standard, and all of these things to move forward in a cohesive way for the industry. Now, regulators are coming on board to help guide this. We have SFDR in Europe. We have the European Taxonomy on Impact Investing that was established a couple of years ago. There's the SEC right now, which has an impact investing framework and rubric that's open for public commentary at the moment. Here in Canada, where I live, our regulators are looking at impact investing and coming up with the construct and a common language as well. And we're seeing voluntary efforts like the Task Force on Climate-Related Financial Disclosure, the Task Force on Nature-Related Financial Disclosure, that are aligning with standards bodies in order to develop a rubric and framework around these themes. In the next 2 or 3 years, I imagine we're going to have a lot more clarity on what the language is, what the indicators are, and how we can track progress in a collective sense.
It's very well said. And of course, once we get these rubrics and actual metrics in place, I think where we all know where this is going is ultimately there'll have to be, I think, some sort of regulation, both from an investor standpoint as well as just various government-driven, and we don't like to use the bad word, but we'll have to sort of carrots and sticks, right, to be able to drive accountability and behavior, both at the corporate level and at the personal level around some of these metrics. How do you think we can strike a good balance where the public will embrace and companies will embrace these types of incentive structures, that we can continue to grow our economies and be successful and thrive, while at the same time getting a fair amount of buy-in and avoiding sort of the free rider problem, which I think we've had since the start of the industrial age, getting to a place where we do put those incentives out there that are embraced and that help us all get to the end goal?
Well, it's a great question, and this is the big work that we have in front of us. I think the next 3 years are going to be absolutely critical for understanding how regulators can come in with both the carrots and sticks, incentives and punishments. I will say another thing though, Peter, in that it's a mindset shift as well, in that the way that you frame the question harkens back to sort of a conventional mindset that we need to make a trade-off when we're making sort of sustainability decisions within a company. I think what we need to remember is what Mark Carney keeps telling us, which is that the future successful businesses on this planet are going to be those that embed sustainability principles into their core operations. And if we think about places like the TCFD, the Task Force on Climate-Related Financial Disclosure, it's not talking about climate benefits as a standalone kind of moral obligation that companies have to work towards. It's talking about the material financial implications of climate-related data and information. And similarly for the Task Force on Nature-related Financial Disclosure. So it's tying climate and nature materially to fiduciary responsibility, both from a downside risk perspective and an upside opportunity and value creation perspective. So I think we need to fundamentally rethink our relationship with sustainability and say, look, it's not a matter of adding it on as a moral obligation because we want this planet to sustain humanity over time. It, in fact, has been treated as an externality, which has not captured the true monetary and economic and fiduciary responsibility of investors by not considering climate and nature previously. So not incorporating it is not the role of regulators and sort of our moral compass to just add on because we think it's a good idea. We're fundamentally misvaluing most things if we don't consider climate and nature in the underlying principles of the economic valuation.
Makes sense. So it should be maybe incorporated directly into GAAP, into the way we account for things, into the core of business itself.
Well, absolutely. And I'll give you a couple of data points which are quite staggering. So one is that I talked about the level of investment in environmentally productive activities. When I came from the nonprofit world, it was roughly $50 billion a year we were spending actively protecting the environment through philanthropic and public budgets. That number has grown to about 200 billion today, and it's increasing over time. At the same time, in 2010, 2011, the amount of money we were spending actively destroying the planet was staggering. It was over half of global GDP. And at that time, that was roughly $45 trillion a year. So we were spending 1,000 times more actively destroying the planet than actively protecting it. And a further data point that's really interesting that comes back to this notion of tying climate and sustainability back to fiduciary responsibility is that the World Economic Forum in 2020 released a report talking about how much of our global economy is dependent on nature. And very interestingly, on an annual basis, they say at least half of our global economy is dependent on the fundamental building blocks are dependent upon nature. So take that in context for a second, Peter. We spend the value created in this world, roughly half or more than half of it is reliant on nature as its fundamental building blocks. At the same time, we spend half of our global GDP actively destroying that core value. So there's no future in which sustainability, if we don't consider sustainability in investment decisions and business decisions, there's no future in which businesses continue unless we fix that problem. Because if we continue to erode the underlying value of our planet, there's nothing left to create value upon.
Yeah, I think that's a pretty amazing paradigm shift. I think that what you just laid out there in a single slide, I think it fundamentally could reorient the way people think about it. Because when you do consider the fact that we are fundamentally spending that amount of money in destroying the planet, that when you look at it through that lens, it completely changes the way you look at the problem. So, and it'd be difficult, but I think you could quantify the total amount of resources that are left. And if we continue to deplete them, if the GDP is dependent on those, at some point we get to the end game and there's just not enough. And then you create a negative feedback loop to where GDP negatively spirals downward. So yeah, I do think that makes a lot of sense.
And absolutely, it's not just the fall of sort of the economies of our planet, but fundamentally we rely on nature as individuals, right? We talked about the ocean previously. We all have salt water running through our veins. We come from the oceans, and if we continue to trash them, we're destroying ourselves. And beyond sort of where we come from and where we're going, without nature, humans don't exist. So we're actively eroding the basis of kind of the future possibility of humanity to exist on this planet.
That makes a lot of sense. A lot of our listeners are private equity funds, venture capital funds, those type of folks. And they do have similarities with the nonprofit world in that they have to go to limited partners or other stakeholders to raise capital. In that world of pools of capital, where do you see deficiencies in terms of types of funds or types of pools of capital that could be deployed into the marketplace to have the biggest impact on these types of challenges that we've outlined?
It's a great question. So I think I'll address this in a couple of different ways. I think there's a stage portion of the answer to this question. There's also a sector portion to the answer to this question. So first of all, what I'd say is, as an investor in private markets, you have more luxury to influence impact than you do in public markets. And that's just the nature of investing in public equities versus private businesses, and your ability as an investor to control kind of how the private businesses operate over time and how they can integrate sustainability and how they, frankly, how they disclose and report to you as an investor. In private markets, though, we have a mismatch in terms of where there's capital available for impact and where there's need. And I would say that we've had an evolution of venture money in the impact space over the last 20 years. The idea and the notion being that we need to seed new innovation and opportunities to address the sustainability challenges in a meaningful way. And there's a lot of we're looking for silver bullets in that space. There's a lot of different segments of venture investing that make sense from a sustainability perspective. However, what we haven't spent enough time focusing on is later stage. So late venture into growth equity and then private equity and beyond. And how do we find values aligned capital that can go alongside these deals and entrepreneurs once they graduate from that early venture space? There's a couple of reasons for why this is the case. I mean, it's easier to raise smaller venture focused funds than it is to raise mid-market growth equity and private equity funds. There's a more systemic and fundamental problem, which is that the folks with access to larger pools of capital in later stage rounds tend to be legacy institutions that have worked through a lot of conventional investing. And it's hard to move those legacy institutions into a more impact-oriented approach. So we're seeing a lot of growth stage companies struggling in the impact space, either because they're going along with partners and capital partners that don't share the values and impact orientation, or they're getting pushed into making decisions that are inconsistent with the underlying impact thesis of the entrepreneurs and the businesses themselves. And a third route that we see entrepreneurs take is just stopping and saying, look, rather than grow even further and potentially risk squeezing the impact out of our business, we'll just maintain at a level that we're comfortable with, but we don't need to graduate into other sources and rounds of financing. And all of those scenarios are subpar, right? What we want to do is to find those opportunities that are ready to grow and scale, to solve and reduce the delta in terms of achieving our SDGs by 2030. And if we don't have values aligned capital to take these ideas from kind of the venture stage into the scaling and growth stage and beyond, then we're not going to be able to address these challenges. I think there's still room for venture, there's still room for innovation, but we have so many solutions that exist today that can really make a dent if we just help scale them, but we don't have enough values aligned dollars to help scale those solutions.
That's a really good point. One of the challenges we see is that in comparison to, say, the internet companies of the last 20 years, once they get to a certain level, they can scale on their own really to unicorn status, because the distribution channel is direct to consumer and it's based on software that can be scaled very rapidly across communication channels. However, in the nature and sustainability space, many of the incumbent players control the value chain in terms of physical distribution of resources or sales channels. A lot of these new technologies have to be implemented with boots on the ground at existing industrial plants that are very, very conservative and would prefer to work with incumbent players. So from an investment standpoint, you have the challenge, I think, of taking a company from, say, 50 or 100 million up to that billion, multi-billion dollar unicorn status without essentially looking to an incumbent player for an acquisition. So you run into some of these challenges there. And I don't know what the solution is. Maybe it's to work through some of the incumbent players to help transform them, or maybe it's, as you say, we have to bring more capital to the late stage venture. And hopefully that capital can be patient, because it takes a long time to put these boots on the ground. Say much different from scaling a company like Google. It's, I think, more like an Amazon, where you have to physically build this distribution and physical infrastructure to be able to support the deployment of a lot of those new technologies. So I don't know what you think about that.
That's really well said, Peter. What I would say on that front, though, is that's the hypothesis behind us combining a consulting business with an investment platform concept, which is that we don't believe that investment alone is going to solve this problem. A lot of what's needed is the supporting infrastructure to allow that investment to succeed. And part of what we think our advisory business does is, because we work with a lot of incumbents in traditionally sort of unsustainable sectors in the resource extraction kind of space, or energy space, or even infrastructure and waste management. So a variety of heavy emitting industries. But we have a client base that are looking for more positive solutions. So if we can, in an advisory mandate on operational sustainability, point people towards solutions that make sense from a fundamental cost curve perspective, and within their core operations, then that transition and that inertia is a little bit lower to get across. However, if you're just focusing from the investment perspective and you don't have access to those potential customers in the same way, it makes it much more challenging. So we're trying to work on both sides. Like, the demand is there, but the inertia is still very real, as you point out. But we can try to lower that inertia a little bit by playing that bridge in between kind of the supply and demand.
Absolutely. It makes total sense. And I think given your long history and background in the space, you've been able to thoughtfully identify an area where you can get the most leverage for that knowledge that you bring to the table. So hats off to you. I'm glad to hear that you're in the market in this way, and appreciate all that you're doing to help further our shared goals of making business really more sustainable.
Well, I appreciate that, but it can't be done alone, right? So one thing I really want to highlight to the viewers and listeners of your podcast is that it's not going to be one or a few organizations that lead this charge and are going to be able to make the transition happen. It needs to be all of us that readjust kind of the mindset of what's possible, what's available, and what the future of investing and sustainability look like. And that meshing of social good, environmental good, and economic productivity is fundamental to advancing not only sustainability on our planet, but future good investment decisions.
Agreed. Before we go, Harry, could you, is there anything, number one, that I missed that I should have asked you about? And number two, is there anything you'd like to share with the audience that you're promoting at this time, or your website? How can people get in touch with you?
Well, our website's Eco Advisors is at www.ecoadvisors.org. Eco Investors Capital is just that, ecoinvestors.capital. The platform is being launched at the moment, so I guess just stay tuned. We're hoping to have sort of a more material and a more fulsome description of what the platform is that we're building by the third quarter of this year. In terms of what I'd like to leave with the group here is that I remain tremendously optimistic about the future of our planet. I think the last couple of years through the pandemic, we've really seen an acceleration of integrating sustainability into at least commitments and decisions. Now we need to move from those commitments into action. And that's where we're fundamentally focused, is on, less talk. I don't care about the next World Economic Forum meeting where people are going to make commitments about 2030 or 2040 or 2050. Let's work hard to deploy some of the money that's been set aside for sustainability and net zero, and actually drive some dollars to action so we can get moving. We've spent a lot of time talking. We know what the challenge is. We know relatively where solutions lie. There's a lot of empty space and wide open space to make really good investment decisions in undercapitalized portions of the emissions reduction pathway that we need to accelerate. And there's a lot of money to be made. So I think the more we can do to mobilize this capital, this interest, and this connection between capital and all its sources, right? Not only financial capital, but human capital and knowledge capital and all the pieces that are necessary to drive this transition. We just need to get after it and do it quickly. I think the next 2.5 years are really critical for this. The IPCC, the UNFCCC, for example, is talking about more action in the meeting leading up to the Egypt Conference of the Parties. And I think the next 2.5 years, if we can deploy, get more boots on the ground, get more dollars to communities, get more of these venture technologies scaled up, the ones that are working, to get them scaled up to a sufficient level and deployed across emerging markets in particular, that we can really make a dent and have even more positive stories to share by 2025 and towards our 2030 targets.
No, Harry, I think those are tremendous goals, and hats off to you for what you're doing. I'm happy to have had you on the podcast. We've had Harry Balasubramanian. He's the managing partner of Eco Advisors, which is a consulting firm, and he's the founder of Eco Investors, which is an emerging investment platform in the sustainability sector. Harry, thanks for being on Energy Superheroes. It was a pleasure to have you.
Wonderful to meet you, Peter, and best of luck continuing with this journey. And it's really important work. So appreciate being here, and thank you very much.